Thank you, Fast Markets, for this Investor Connect. We have Ernie Ortiz from Lithium Royalty Corp as the main investor at this conference. I've known Ernie, I think, going back at least till 2015, 2016. Let's give you a bit of your background, but you are now CEO of Lithium Royalty Corp, which for a long time was private and giving royalties to a number of companies, but you went public last year. I think the only IPO on the TSX last year, around PDAC in March. You raised $150 million, I believe. But like all lithium stocks, the IPO has not performed so well. So just tell us a bit about yourself, your background before you came to Lithium Royalty, what you were doing, because very few investors have been investing in lithium as long as you have, and therefore your perspective on where we are in this bear market. We've been through a lot of cycles before. I think your perspective will be very valuable.
Sure. Thanks, Howard. Hi, everyone. So I started my career in equity research at Credit Suisse in New York in the chemical sector. So we were basically looking at basic materials. And as part of that coverage, we covered names like Dow, DuPont, and so forth, but also companies like Rockwood and FMC, which have now become Albemarle and Arcadium. As part of that initial coverage and exposure to the research sector, I was the principal author of Credit Suisse's Lithium Primer back in 2014. Had a decent kind of early start in the commodity over now 10 years ago that primer has been in circulation. Subsequent to that, I went to a hedge fund in Connecticut that was seeded by Chris Shumway from Tiger. And we became large investors across the space. We were the third largest of SQM at some point, eighth largest of Albemarle, and big believers in the thematic and so forth. And then in 2016, did a site visit, met a gentleman called Blair Levinsky. He's the co-founder and CEO of Warata Capital Advisors, which is a multi-billion-dollar asset manager in Toronto. And then we got together with our third co-founder of LRC, Mark Wellings, to start Lithium Royalty Corp. And that's how the business got started. So in 2018, we got our initial dose of private capital. We went to acquire 4 royalties pretty much right off the bat. And now we've grown to 35 royalties diversified globally. We have 3 in production, 3 more are expected to start production by the end of this year. So we'll have 6 by the end of 2024. It's a very scalable business. We only have 10 employees. Our SG&A is around $5 million USD per year. So we can certainly ride out any commodity cycle, and we can be patient and contrarian investors. But yeah, that's the genesis of LRC, and we've been big believers in the sector and look to continue to invest in the commodity.
Great. I remember coming here, I don't know, in 2016 or so. SQM had just invested in Lithium Americas. SQM stock was rising from like $15 to $50 and $60. At that time, they were producing, I think, 36,000 tons. They're now producing something like 240,000 tons. Again, come to this conference a few years ago, and Deutsche Bank had a Lithium 101 that everyone was reading on the plane on the way to here. And they were forecasting at 2025, the market was going to grow from like 150,000 tons to 500,000 tons. And we're now at more than 2 times that number as we're approaching 2025. But SQM stock is lower today, despite that huge increase in volume. And lithium was supposed to be the specialty chemical. There's going to be this great boom. There have been booms, busts, booms. We're now in a bust again. What do you make of this as an investment class? I'd be a long-term holder, but it seems better to have just been a trader. What do you make of the sentiment is negative here? Albemarle was saying, the headline from Bloomberg, they won't invest for North American supply or ex-China supply unless prices are 20,000 again. I think you're a bit more bullish than a number of people, as am I. What do you, like the bull bear, what are you looking for, like going into this second half of the year and next year, just market data points wise?
Sure. So maybe touch first on the cycle and then what we see in the second half of the year. So as far as how we approach lithium investments, we think it's very similar to any other commodity cycle. Typically what we've seen, lithium cycles last between 2 to 2.5 years. This has pretty much been the case for the last decade or so. This lithium cycle peaked in November of 2022. Based on a timing basis, it does suggest that we are getting at or near the bottom. We could have already passed it. Of course, there's going to be some kind of valleys and troughs and so forth, but on a timing perspective, it does seem like we're pretty much there, and especially with, like you said, Albemarle not reinvesting at these prices, especially in the West, it does suggest more so that we are at the bottom and so forth. So I think from a cycle perspective, we view it very dispassionately. So it's still demand's growing quite quickly. We are pretty bullish into the second half of the year and even more so going into 2025. But from viewing it a commodity standpoint, it's just the typical cycle that other commodities enjoy. And what we've seen with lithium, at least, is that the lows seem to be higher every single cycle. So the prior cycle, we saw spodumene hit around $300 per ton. And now if we have passed the cycle low in this scenario, then that would have been around $800 to $900 per ton, 3 times what we saw in the prior cycles. You are seeing marginal costs continue to rise, which is what you want to see in a rising commodity, rising demand type of opportunity and type of environment. That's certainly very positive from a longer term perspective. And then as far as second half of the year, we are relatively bullish as far as demand is concerned going into second half and then 2025. And if you just look at it by segment of the market, so Chinese EVs have certainly outperformed expectations so far in 2024. And that makes up roughly half of annual lithium demand. So the biggest segment of the market is probably growing 30 to 35% year to date versus expectations of 20 to 25. So you are seeing that add a positive boost to the overall sentiment. But obviously, I think sitting in the West, it's harder for us to track just how impressive that growth is. If you look at the top 10 brands in China, only one of them is a Western OEM, Tesla. The rest are domestic based. The other key things that we're looking at in China that makes us relatively bullish in the second half of the year are all the new entrants. A case in point would be Xiaomi, which released their new car in April. And if you'll believe their guidance, which is over 100,000 units sold in 2024, that's 0.7% incremental demand that probably no one really knew about in the last few months, given that model was just introduced in April. So you are seeing some pretty encouraging signs in China. Other key thing that I would mention that will be interesting to see, especially as we go into the next 6 to 12 months, is just the rise of extended range electric vehicles. So there's no kind of surprise that plug-in hybrids year to date have been outperforming battery electrics. But last year, about a third of the sales were extended range. So it's not its own category, but it's getting clumped into plug-in hybrids. And those tend to have battery sizes that are very comparable to battery electrics, usually around 40 to 45 kilowatt hours. So you could have a scenario where the people are kind of underestimating the battery content because they're plugging it all into the PHEV category. So we think that's also a potential demand boost going into the second half of the year and into 2025, especially since I think the last numbers I saw is extended range EVs are growing at 100% year over year in the kind of the latest monthly figures versus PHEVs are growing at 60%. So they're growing at much faster rates at a much higher battery pack than the rest of the industry. I think also in the West, we have seen a lot of idiosyncratic events. So in January of this year in the US, as we saw, there was a new interpretation for the Inflation Reduction Act. So we saw 42 EV models that were eligible for the subsidy in December. That got down to 19 in January, kind of January 1st. So that cut in half of the available models that qualified for the subsidy, I think presented a lot of volatility in the first half of the year. Even more so, you are seeing a lot of new models being introduced in May, June, and July of 2024 that I think we just have to let them be in the market to see how well they performed. But key ones being the Equinox EV from GM, that's around $35,000. So there's a pretty nice entry point in the context of other EVs that are, call it 50 to 55,000. So even on the new GM guidance, which they reduced the top end, about 85% of their sales guidance for EVs in 2024 is second half weighted. So if they actually hit their numbers, that's an extra 1.5% incremental global demand boost just on GM sales alone in the second half of the year. So that's what our thoughts are with regards to North America. And then lastly, when it comes to Europe, clearly Germany has been struggling. I think that's the sales there have been pretty sluggish. But on the opposite end, France has probably been outperforming. They actually had to essentially reduce the subsidy regime in the first quarter for some of their entry-level EVs because it was so popular. So we are seeing some positive news front on that end. But probably more importantly for Europe going into 2025 is the CO2 fines and emissions that get enacted or start being essentially in force in 2025. The number of EV models that have to be released in order for them to avoid those fines is pretty immense. The last time we saw this was in 2020, and we saw EV sales triple in 1 year because they had to comply or else they would have had a big fine to contend with in 2020. So you are seeing the number of EV models that are affordable being more ambitious and actually more in the market now in the second half of the year. I think Citroën just released a 30,000 euro car a few weeks ago or so. So you are seeing those affordable platforms being introduced, which ultimately is what we think will drive the market, especially since last year, 2/3 of the electric vehicles in China were cheaper than their internal combustion counterparts versus 5% in the US and 15% in Germany. So yeah, as we see those affordable models hit the market in the second half of the year going into 2025, we think the Western markets could have a nice resurgence. And probably lastly is energy storage. I think that's probably one area of the market where it's harder to get information. It's probably not in the general vernacular when it comes to lithium demand. And I think Bloomberg's latest estimate is 61% year-over-year demand growth in gigawatt hour terms, which I think based on the demand numbers I've seen in the sell side community, those are not really reflected at that level. So obviously we'll see how the second half transpires, but there are a lot of positive data points that I think probably are not yet reflected. And some of it's also, it has to be proven, right? Like we'll have to see if GM actually hits their guidance and if the sales actually perform and so forth. But there are positive elements that we can point to that could absorb additional supply sources this year.
Okay, that's great. So you added a lot of ex-China demand positives because right now the narrative is very negative ex-China. So that was great color. One addition to that I keep pointing to that no one seems to really be paying attention to is 4 years ago, there was a lot of hype going into kind of Tesla's battery day, right, just before the election. And now, August 8th, they're having this robo-taxi unveil, and he's focused on robots and AI, et cetera. But he's also said in his last quarter call that he's going to introduce new models, right? He has 3 million EV capacity, but he's only producing 1.8 million cars. Do you have any thoughts or insights? Tesla stock has been performing better since the first quarter call, and there was a lot of bad news with layoffs, et cetera. But often lithium equities and sentiment toward lithium is correlated to Tesla. So any thoughts on the upcoming robotaxi unveil and what models he may unveil there?
Sure. So I think no direct thoughts or comments on the unveil, apart from it just probably generating additional news flow and attention to all the kind of positive developments that we're seeing in the electric vehicle sphere. But probably other kind of positive news that we saw yesterday was the investment with Volkswagen and Rivian. So I think all of those new investments will continue to shine a positive light into the sector. The other non-Tesla news is the new plant from Hyundai that's expected to start production in October. And that will allow them to qualify for additional subsidies to then pass off to consumers in Georgia. So I think now the market, at least in North America, is starting to develop in a way where other companies beyond Tesla are starting to matter. And probably the key one is probably Hyundai and Kia. And we are seeing some pretty impressive models be released. And I think the EV3 was just released in Korea at $30,000. So I think Tesla's no question probably the most important kind of news flow item and company to generate attention. But we are seeing that diversify, which ultimately is a good thing that we're seeing other big proponents like Hyundai and Kia continuing to invest in such a big way.
Great. I now want to turn to supply because I remember being here in 2019 or not here, but in Santiago. And one of the big bears in the market was Morgan Stanley. And we recorded Javier, and he just said, with commodities, what matters is supply. And he was thinking that SQM, who he covers, can just unleash a lot of supply. But there's been a lot of supply from China lepidolite, and there's been supply from Africa. And prices, we had a bump, and now prices have come in the last kind of month or so. What do you know of? There's a lot of speculation on how low cost or high cost is China lepidolite and how much that could scale, and likewise in Africa. So if you could give us color on that.
So I think no question that Chinese lepidolite and Africa are going to be positive additions to supply, but there's also offsets for projects that have either slowed down or have actually seen reductions in overall production growth. I think we always talk about kind of the additions, but we also need to talk about the offsets to that. But when it comes to lepidolite, our view was that last year there were around 11% of global supply that could inch up to around 13 to 14% this year. They did have production down in the quarter, both on a sequential basis and also on a year-over-year basis, largely driven by the inspections, given some of the waste concerns of the thallium and the beryllium. I guess how we approach lepidolite is that there's probably multiple segments of lepidolite. The easiest way that we classify it is probably integrated versus non-integrated. And non-integrated, I think, is having a much more challenging time. And based on channel checks, I think we're of the view that the cost profile for those producers is around mid to high teens, which I think at these levels, they're probably challenged. But the integrated producers are probably in a more advantageous position because of the different elements of their downstream and different parts of their business. And that could put their cost probably in the low teens, potentially as high as mid-teens, but in an area where they're probably at least probably maybe cash flow break even at these levels. So I think that's where we're probably seeing still some additional sources of supply, but it's very different conversation than I would say last year, when I think some forecasts I saw had lepidolite producing 300,000 to 400,000 tons in 2024. I think even probably the biggest bulls on lepidolite don't have those types of numbers this year, and probably largely because they are slowing down given the pricing situation. In Africa, I think we are obviously seeing additional supply growth from Zimbabwe. Those are ramping up relatively quickly. But then again, a lot of it was probably in the supply numbers. I think most people had Africa coming in a big way in 2024. Now, on the offsets, I think you have seen a lot of projects in Argentina be delayed, probably by 6 to 12 months. So I think that's also going to reduce some of the LCEs coming out of Argentina. Additionally, you did see Australian exports into China down 20% year on year, which in a market that's growing 25% a year, it's a significant reduction in actual tons that are hitting the market. And actually, just one point back on Africa, yes, we are seeing tons exiting the continent, but the key thing to probably consider is the LCE values of those tons, because you could be getting rock out, but what grade are those tons out? I think one of the other data providers recently put out an inventory number where they estimated that 60% of the actual inventory held in China today is at a sub 4% lithium oxide content. And if that's the case on an LCE basis, the inventory levels are much less severe and so forth. So I think that's another probably more important qualification that you have to think about when it comes to Africa. But either way, I think we're of the view that the surpluses are likely not going to be as severe as what's forecasted today. But we just talk about what we saw in the last conferences, where people would say there's going to be deficits for the rest of the decade, and now it's almost flipped, where now everyone's saying there's going to be surpluses for the rest of the decade. So I think we're just a little bit more balanced. We think the rest of the decade is going to be plus or minus 3% oversupply, undersupply in any given year. And as a long-term investor in royalties that are perpetual in nature, we're just going to be counter-cyclical and continue to invest in the downturns.
Thanks for that. Okay, so I want to just go geographically and by project type, because most of your royalties are in hard rock. Are they all in hard rock, or do you have...
No, we have 2 brine projects, and then we have 3 sedimentary projects.
Okay, so if you could just... I'm noticing at this conference, there's a large presence of the state of California and Exxon sponsoring this conference. So like the DLE in the United States, and this was true of another conference I went to not long ago. So if you can, from a North American supply chain, oil companies are getting in the game, government support is here, and also government support for sediment from both Lithium-Americas and Ioneer, compared to, let's say, Quebec, Ontario, Carolina. Could you, in developing a North American supply chain, what are your thoughts on different projects or different types and what you're seeing? Because there's been a bit of a rise in these unconventionals.
Sure, and I think it's also, as the market evolves and matures, the unconventional term changes. Probably 15 years ago, hard rock spodumene was unconventional when Chile and brine controlled 70-80% of the market, and now we're seeing almost Australia 50% of the market with hard rock. So I think as it evolves, these things will ultimately become conventional as the market needs this additional demand and supply to balance. If we're going to be around 1.2 million tons of demand more or less this year, going to 3 million or so by 2030, I think we'll need many additional sources of supply. But you're right, we do have a bias towards hard rock, and that's probably related to us being a relatively new company in 2018, when we wanted to have a bias towards cash flowing assets. And as we know, hard rock projects tend to be brought online much faster than brine, and they're also much cheaper than brine. Kind of case in point would be our second spodumene investment was with Sigma Lithium back in 2018. That phase 1 there was around $130 million, and they were pretty quick to market, and they're going to be bringing on phase 2 next year for about $100 million. The capex profile for hard rock is much smaller than brine, but that's not to say we're afraid of brine. We do have 2 assets that are in construction and are going to be imminently in production according to our operator's guidance. One of them would be Zijin Tres Quebradas, who has mentioned that they're going to be in production or start production in August of this year. And then Gangfeng Mariana project in Salta, they're expected to start production by the end of the year. We're very positive on both, but no question is if we do need 300,000 tons of additional supply every single year, I think we will likely need DLE. We'll need sedimentary closer to the end of the decade. And I think how we approach DLE is probably very similar to how we're doing it with other assets. We want, to the extent it's possible, low cost, And when it comes to DLE, it's probably more, there's a lot more technology risk involved. It's not like a blanket term. I think Patrick had a good phrase yesterday. It's not only about the technology, but it's also about the asset itself that you're looking into. I think we are evaluating different DLE investments. At the same time, we do have a bias towards a proximity to cash flow. So I wouldn't expect us to invest in assets that are extremely long dated and then also have technology risks. So if there are DLE opportunities out there, I think we'd probably look at something that's closer to production rather than longer dated.
Did you have fresh capital to deploy still from the IPO proceeds?
Yeah, so we do have a little over $10 million USD in cash, and we also have $25 million undrawn facility with National Bank. We had $5.5 million of revenue last year, so I think we only lost around $300,000 or so of EBITDA, and we're going to have 3 more projects this year. We have pretty scalable business model, as I said, pretty lean organization, so we should have additional cash flows, especially coming in the second half of this year, going into 25 to continue to deploy.
Okay. And I know you were also invested in Winsome Resources and maybe some others in Quebec. I recently visited that, and I was just thinking Quebec, you have Arcadium, which is going to build a converter, but right now there's a freight differential disadvantage when selling spodumene from Quebec, North America, and Piedmont are doing. But there are 11, 12 aluminum refineries in Quebec. I see a future of 10 conversion plants for the Quebec narrative, Patriot, et cetera. But compared to Western Australia, like SQM came into Kidman and then West Farmers came in and they're going to build that. You have a lot of juniors who don't necessarily have the expertise to go downstream, like Arcadium is going to do it. Like, how do you view the spodumene to hydroxide in Quebec and maybe Ontario challenge compared to, let's say, Western Australia, which there's Kwinana, there's Kemerton as well. They've had some challenges, but it's happening. You're having conversion there, but you have to have the conversion in North America. You can't for the North American market. How do you see that playing out?
Sure, I think this is part of the evolution process. Australia is no question very far ahead versus North America and Europe, partially because they've been in the market for longer and so forth. But I do see that happening. I think many of the major downstream players have announced plans to build cathode, to build hydroxide plants, and there's a lot of government support, which is probably different than what we saw maybe 5 to 10 years ago, where governments are actively promoting and trying to cut the red tape to accelerate these plans for downstream investment. And similarly, I think you are seeing someone like a Piedmont trying to build a Tennessee hydroxide plant. So you could have merchant facilities in North America that take up spodumene in domestically, but you could also have situations where it also feeds the European market. So especially with the kind of ESG friendly material, there's a lot of new converting plants that are being built in Europe. And Europe is, given they just have a lack of abundant lithium resources, there's probably a need for additional importation of lithium units. And you could see North American hard rock resources supply the European market. But either way, I think the downstream plants are coming in both North America and in Europe, that I think over time it won't be a problem. But it could be a situation where maybe the initial years, whether it's Winsome or other producers, maybe they do sell spodumene on the merchant market. But at least for us, we feel very advantaged in something like a Winsome that we think is going to be a very low cost position, that even if they sell to the open market, they'll still be making significant margins. And that's one of our probably biggest value drivers for LRC. We have a 4% royalty on Adina. That's a 77 million ton asset with more drilling to come and a new mineral resource expected in the first quarter of 2025. That could end up being one of the largest assets in the Americas in the coming months, which actually it already is, but it could go over 100 million tons based on the kind of drill results that we're seeing and so forth. So we're very excited by the development path that Winsome's undertaking.
Good. Hope you're right. When you price your royalties for spodumene, what long-term spodumene concentrate price you're using? I remember a few years ago, like you were saying you maybe should have been more aggressive because you were using like $600 and that prevented you from deploying some capital in some of these projects. Obviously 600 is too low, but what are your thoughts now in deploying? What price are you using?
Sure. We use the consensus curve as a ceiling when we price our royalties. So right now, the long-term average consensus price, if you look at an average of 15 or so different sell-side analysts, is around $14.50 per ton. We're not willing to go above that. And usually we use kind of the minimum of spot and the long-term price. So spot's around $1,100, $1,200 a ton today. That's probably what we're using, or close to what we're using on a long-term basis. Yeah, essentially we try to use the lowest price as we can in a negotiation. But obviously there's different elements to when we price out the royalties. Of course, price is a big component, but timeline is also another key element there. And typically we do delay a project versus kind of the original company expectation because we see just general delays, whether it's permitting and so forth, that can arise. So we need that additional source of protection. And then also on the volume side, we do take a much more conservative approach versus kind of company expectations, again, for that protection. And then once you have plugged in kind of those three main components to model out the revenue and hence the top line revenue royalty, we normally seek mid-teens after-tax IRR for us to get excited about something.
Okay. Country specific wise, you mentioned Sigma. I think you have royalties as well in Atlas, and there's Lithium-ion, and I think you're in Latin Resources as well. Are you not?
We have a right of first refusal on land resources.
Okay, so you're in two half in the Brazilian, the public ones. But what are your thoughts on Brazil as a jurisdiction for future growth? And what other jurisdictions in Africa? There's been Zimbabwe, but Ganfeng's in Mali, Atlantic's in Ghana. We're hearing lots of private companies in, I don't know, Tanzania, Nigeria. So if you could just talk about new kind of spodumene jurisdictions.
Yeah, so Brazil has been a big growth driver for the company. We have three actually investments in Brazil. Sigma, which we did in 2018. Atlas, which we did last year, $20 million transaction for a 3% GOR. And we actually just did a recent one in the first quarter with a private company called M4E, which Sergio was actually here in the audience. But we're extremely bullish on the potential for Brazil. I think on our numbers, it's probably the cheapest jurisdiction in the world to bring up a hard rock project on a capital intensity basis. On an OPEX basis, probably very comparable to some of the other kind of leading mines around the world. But on a CapEx basis, you look what Sigma did, it's $130 million CapEx to bring 270,000 tons of production. And then you're seeing Atlas's numbers of $50 million for a 150,000 ton modular plant in almost record timing. I think it's almost the leading jurisdiction and the fastest jurisdiction in the Western world to bring on hard rock production. I was just there 2 weeks ago, and probably the level of support that we're seeing from the government is extremely impressive, where the governor of Minas Gerais, kind of key mining state there, he opened kind of their marquee lithium conference, and they're almost trying to cut as much red tape as possible. And you are seeing a lot of major players take note. There were several mining houses at that conference that were taking notes and just educating themselves and the Brazilian opportunities. I think you have 15 assets today that have a mineral resource in Australia, and most of them are in kind of the Goldfields region and the Pilbara region. Could I see that happen in Brazil? I think so. I think there's the potential to have multiple world-class deposits, which obviously right now many of them are aiming to get into production as quickly as possible. But I wouldn't be surprised if in 2 to 3 years, once they're in production, we start talking about who's going to consolidate the Brazilian ore bodies, because there's could be many that are over 100 million tons and pretty favorable geology. You can drill year-round. The drilling cost in Brazil is $200 per ton, which is pretty cheap compared to seeing some other jurisdictions that are also world-class. We're big believers in Brazil. Our core thesis for hard rock has been what we like to call the hard rock ABCs: Australia, Brazil, and Canada. So those are the areas where we want to continue to deploy capital and to grow. No question, Africa is going to be a big driver of lithium units in the coming years, but we think there's a lot of low-hanging fruit kind of in those ABC regions, which we have a lot more history in. We also have done deals. We have a local legal counsel there, and we feel we have a head start and a competitive advantage that we're probably going to continue to deploy resources there. One
after ABC is D, and there was news on the tape in the DRC that RCF wants to buy AVZ, a lot of letters there, for 1 cent per share. RCF is a pretty astute investor, people who have been locked up. I don't know if anyone will sell into that, but there is the potential for this monster of Monono in the DRC if Zijin can figure it out. Could you quantify that as a potential supply risk in the future?
Sure. I'll probably refuse to speak on kind of individual assets outside of our portfolio, but no question that's one of the largest deposits in the world. And depending on the timeline, that could have a significant impact on the supply models for everyone. But so far, it seems like there's still a lot of development to consider before confidently adding them to any supply number in any specific years. Yeah, I think I'll probably refrain just from adding too much, given it's not in our portfolio and it's probably not another key area that we normally navigate in.
Okay, and I'll go back again. We've had lots of history. I remember in 2019, I think we were at LME. There was a panel. Will Adams from Fast Markets was here on the panel, and Daniel Jimenez, you were on the panel. And they asked, the final question was that this was the bottom of pricing, I think, in 2019. where would pricing be like a year from now? And they were all super negative, and we were talking afterwards, you were positives. I feel like we're in a similar kind of dynamic here. There's a lot of negativity out there. When we regroup here next year, and there has been a lot of negative narrative, are we going to be more bullish? Where do you think pricing is going to be? And what will we look back at a year from now and say, oh, we didn't see?
I do think we'll likely be sitting here next year with prices being higher than where they are today. I don't think we're going to be all-time highs, a ebullient mood, but I think it's probably, if you look at normal cycles within lithium, I think you are starting a new one kind of in the next probably 6 to 12 months. And I think by then you'll probably start to see prices rise with a little bit more momentum. I think based on where prices are today, the supply deficits that are forecasted are likely too optimistic, especially if everyone's producing and supply and kind of pushing out their own internal numbers. If you look at the major producers in the world, they all have significant kind of negative free cash flow at these prices, and still with capex that remains to be completed. I do think that based on even marginal cost economics, maybe you'll have 10-20% downside on kind of the price versus on a cyclical basis versus maybe over 100% type upside type of opportunity. So as a longer term trade, I think there's a lot of positives that offset the negatives.
And do you agree that like 20,000 is like the incentive price? Like we need to get there, and then if we do have deficits, it's a commodity, so things will overshoot on the upside, overshoot on the downside. So do you agree that 20? We need to get back to 20, and then beyond that, everyone says, okay, we're never going to get back to 80. There weren't a lot of trades done at 80, but what do you think is the upper limit that kind of brings on some of the higher cost supply?
Sure, it's hard to know where the next peak will be, but I think as an incentive price, we could even, in a longer term price, we could even go above 20. And just looking at the capital intensity for some of the major projects in the world. So some of the more scalable, low cost, best in class projects in Argentina are now around $25,000 per ton capex intensity. And that's for very favorable jurisdiction, very high grade asset. Some of the North American assets that are perhaps more or less conventional, their capex intensity is around $40,000 to $70,000 per ton. So maybe that's somewhat of a guide as to what type of incentive economics that needs to occur for those assets to be brought into production. I think that's probably the best way to think about potential ranges of outcomes, is looking at the capex intensity across kind of different grade profiles and different levels of maturity of the assets in the sector. And that's how we're looking at it. Look, if you need $20,000 per ton kind of incentive price for an Argentinian asset, and then North American, less conventional, $40,000 to $70,000 per ton, it gives you the potential ranges of what could occur. And like you brought up a good point. I'm not saying that there is going to be a sustained period that could see those prices, but it gives you a framework for potentially how to think about the ranges.
Okay, I think people like Paul Graves at Arcadian were saying like 20,000, but could go up to 30, and then new supply will come on. I'm just trying to think again, going back to SQM was at $50, was it over 100, it's now back at 50. So if lithium is now, could be great, buy the dip, but when to sell for those kicking themselves that they didn't sell 6-9 months ago? Like at what lithium price are people like, what if it gets to 30, 35, people think, oh, it's going to 50. Are you selling at 30? Are you selling at 35? What do you think?
Yeah, I think that's probably a more of an individual question for investors. It probably depends on everyone's entry point. But as far as kind of for LRC is concerned, we do like to be counter-cyclical, but at the same time, we're pricing our royalties on pretty conservative economics, both pricing and volume wise, that we're almost cycle agnostic. We've done deals when the market was pretty ebullient, and we've also done deals when there was no one else around to provide capital. I think we approach it as, so long as we get into an investment with very conservative assumptions with a lot of potential optionality, we're almost cycle agnostic. And another kind of key point that I should mention is when we do our investments, we never give any credits for either byproducts or additional expansion. Sigma is a great example where we predicated our investment on phase 1 production alone, and now they're adding phase 2 next year and likely phase 3 in the next couple of years or so. And all of that's incremental upside. So I think if you price investments properly, I think you can almost be a cycle agnostic, especially for someone in our position that it's a perpetual royalty investment.
Okay, great. I love the royalty model. It's been very popular in the gold space. You guys have been a pioneer in launching it for the lithium space. You have very few employees, so in general, you should trade at high multiples. But as an alternative to an ETF that is owned producing companies, if you want diversified exposure to the lithium space, that's what LIRC offers, and Sigma is one of your great investments, and but there are a lot of others, right? It's just a differentiated way to play if you don't want to buy individual stocks. And I really appreciate your educating all of the listeners here and who will hear this later about your investment approach and also your relative optimism to the wet blanket that has been more evident in this conference. I don't have any more questions. I think I just want to thank you very much, Ernie, for joining us today.
Great. Thanks, Howard.
Are there any questions from the audience?
Hi. Question on the royalty valuations. You're talking earnings. You're pricing it potentially on a price earnings type ratio. You're coming in at phase one, but you have a royalty of the whole asset, right? So somebody's got 20 million tons of lithium. You've got the royalty on the whole, but you're actually pricing it on the first couple of projects.
That's right. So typically the royalty will cover a property. So call it as a one claim, and then there's 5 million tons on the claim now. But if they get 100 million tons in that claim in the future, we'll still have access to, if it does get to production and there's revenue generated from that claim, we do have access to all that incremental optionality.
So I'm just wondering then, if you do that, and I'm in this situation now, when I look at this industry and try to price it on a price earnings ratio, like you would for many equities, and we're not at project economic pricing yet. We're not looking at EBITDAs of phase ones. We're all publishing PEAs with an NPV of $1 billion and IRRs of 40%. If that was the case, the cash flow generated from that first project would mean a market cap of God knows what, over $1 billion, right? So are you in the state, if you're actually doing price earnings ratio pricing, are you in the state where sometimes you're paying the company more for its asset than its actual capitalization in the market? Are you overvaluing because you're looking at earnings and pricing it as in they're going to do this much ton, this much profit, and therefore we're giving them this? Are you ever pricing above where their market cap is, or are you always lower?
No, I'll have to confirm, but I think for the most, if not, I think all of them have been below their market cap, because usually, like for example, the royalties are usually valued on price to net asset value. Usually it's a big discount to net asset value just by nature of the, I guess, the maturity of the investment, the maturity of the companies. Is to your point, if they have an NPV of $1 billion, we're not going to be pricing our royalties on those relative economics. So there is a kind of P to NAV discount that's associated with the investment.
So you have faith in the fact that the market is pricing these companies correctly?
No, not necessarily. I think part of it is just our own kind of, we do our own kind of geological work. We do our own kind of view on the resource and ramp up in production and so forth. Is why I alluded to sometimes our volume can be significantly lower than the PFS or feasibility studies. We're doing our own economics. We do have faith in our overall assumptions, and then we priced it on that regard.
I could ask you later, Ernie, just to clarify. When you said $25,000 a ton capital intensity for an Argentinian brine, all-in sustaining cost will be, say, $7,000, cash cost plus sustaining capital. $15,000 incentive price less $7,000 is $8,000. $8,000 is a 3-year payback. A 3-year payback is probably a plus 20% IRR. An incentive price is actually $15,000 a ton. That's different than a $25,000 capital intensity, correct?
Correct.
Any other questions?
My question is, Howard, you asked where we're going to be next year. A question for both of you, Ernie and Howard. How are you guys looking at the potential duration of this potential downturn? It's not so much a point in time, but how long will this bottoming process take to work out the excess inventory and to essentially start to see some supply contraction to tighten up the market and move it forward, plus or minus?
Sure, it's a very specific question, but I guess maybe we are seeing a lot of progress. So even 6 months ago, and maybe in a year, 6 to 12 months ago, the concern was the battery inventory, and that was around 6 to 7 months, and now it's worked down to a month or two, and especially the larger battery players essentially appropriately destocked. And if you look at kind of the battery consumers and the cathode makers, the majority of them are talking about potential restock in the second half of the year, but obviously that's predicated on if those Western kind of demand numbers come to fruition. So I think we'll have to see just how strong this potentially second half 2025 numbers, whether they materialize for EV sales. And if that's the case, then I think you could have a more optimistic environment when it comes to price. And like I said, I don't think we're forecasting where we expect new all-time highs anytime soon, but I think probably a little better than what we're at now.
Never found it more difficult in my 15 years of doing this to really have conviction as to timing. To Ernie's point, we're 18 months past peak. So if the last cycle was like 2.5 years, a year from now would be great. But election, the negative demand narrative, the opaqueness of the supply of China, and there are analysts who UBS just did a tour to China, and there are arguments there that actually the integrated lepidolites are cheaper than people are saying because they have feldspar and quartz byproducts, and they figured out how to separate the hazardous waste from the industrial waste. And then you have other people that says, oh, you can't believe what the Chinese are saying because they're always going to lie to you. But I'm sitting here in New York, my partner's in Mauritius. We talk to a lot of different people. We don't have all the people on the ground like Goldman Sachs does or Shanghai Metals Market. It's very difficult to know. But the last 10 years have shown lithium was the best performing commodity 4 out of the last 10 years. It was also the worst performing 4 out of the last 10 years. So in the next 2 years, we've had a big bear market. We're going to have an upswing again, but just don't believe it's sustainable when it happens, and be smart enough. You never go broke selling at a profit. People, I thought, I mistakenly, I took some profits, but I expected this year to be a negative year from an election point of view. I just knew that there would be just negative narrative, and also with higher interest rates and post-COVID, the EV thematic and low interest rates and the stimulus. But I was 6 months late, right? I didn't expect, I thought we would have a year-end kind of bounce, and I should have listened to Goldman Sachs and other people who said lepidolite and Africa, and other people saying, no, just don't be so dismissive of the motivations of intelligent banks like that. On the other hand, Morgan Stanley's always been negative, but they've never called a bottom. They've always called the top. And other people who hate lithium, and they're right when you go into bear market, but they don't call the bottom. We're doing the best we can. It's a young, fast-growing industry. No commodity we've ever experienced in our lives have been growing at this pace. Every single element of the supply chain. The auto industry, the ICE auto industry is a cyclical industry. So the EV industry is a cyclical industry. Batteries is a cyclical industry. Cathode is cyclical. The chemicals and commodities are cyclical. So all of the supply chain is cyclical, and none of the supply chain right now is making money. You're having price wars on the EVs. So we still fundamentally believe the world is moving to EVs, the world is moving to ESS, and lithium is going to grow fast. But it's going to be a traded commodity, so just find the right people, right projects. It's also complicated to this point I was making. We're a believer in hard rock. I created this moniker of the North American Lithium Triangle from Carolina to Quebec to Ontario, but I see a lot of investment dollars going into Arkansas and Texas and brines, and the oil companies coming in, the Salton Sea, and there's government push. Government loves geothermal, and the sediment has gotten funded. So it's not a no-brainer that, as I used to believe, that Quebec is going to build and Carolina is going to build 10, 12 different hydroxide plants, which you need, and the CapEx intensity of those things have increased a lot. I think it's going to happen. I think you need all of the above. But it's right now, it's just, I can't tell my friends to buy XYZ stock, which I did tell them 5 years ago, and I did tell them 10 years ago. So I'm a little bit gun shy. But broadly, if you buy a diversified portfolio like LRC, or if you buy the Sprott ETF, or you buy like Arcadium, Pilbara, Albemarle proxies, good producing companies, I think they're going to be higher sometime over the next 3 years. So I would buy safe companies like that. Development companies is just tougher.